Look at gold. Got the snot kicked out of it by over $100 last week on Friday. And what are we at today? Well, we're up $108 right now as we speak. The physical demand is different than I have ever seen, as are all of these things. People at that level, speaking to institutional traders at that level, saying 25% allocation is good. Never seen that before, man. I didn't.
You're watching Silver News Daily. Subscribe for more.
They just detonated a financial nuke, and no one's talking about it. The largest silver refinery in India has run completely dry. Lease rates are exploding past 39%, and the physical market is so broken that the spot price is now higher than the futures price for nearly 3 straight weeks. That's called backwardation, and it's one of the rarest signals in precious metals history. But it's not just rare, it's a warning. The kind of warning that comes just before everything blows wide open. Behind closed doors, the Federal Reserve is quietly funneling nearly $500 billion to collapsing regional banks, pawning off toxic mortgage debt like it's 2008 all over again. And while Wall Street sleeps, institutional insiders are scrambling, loading their portfolios with gold and preparing for silver to go vertical. We're not talking about a slow grind higher. We're talking about an imminent price detonation that could send silver screaming past $500 an ounce. And the signs are everywhere. 18 days of backwardation, physical shortages spreading across the globe, and short sellers so trapped they're paying double-digit interest just to stay alive. Something massive is brewing under the surface. The paper markets can't hide it anymore. So the only question now is, when does it snap? Because when it does, silver won't just move. It'll launch.
Not even close. Since 1971, it's not even close. And that's not even worth talking about it. And traditions of central banks prior to 2017 for many years, like 2008 through, or for sure 2011 through 2016, they were net sellers of gold. Most central banks are net sellers. The United States has been a net exporter of gold, and all of a sudden we're the biggest importer. But I'll say it this way, as do you, every week when I do these shows, I need to prepare, and I spend 2-3 hours a day, pretty much 6 for sure, sometimes 7 days a week, studying. And every story that I find that I want to talk about, I will try my damnedest to validate it everywhere else, running it through Google, running it through various forms of AI, searching for other stories, other validations, because there's a lot of misinformation out there, even through, people's best intentions. But something like that is anything but best intention. And, you have to wonder what the motivation is. And here again, shame on YouTube for letting this stuff out there. They were so quick to put a strike against you and remove your video for saying the wrong thing during the previous administration, which was just actually proven to be mostly true. Yet this kind of stuff, which is far more damaging on many levels and deceptive, intentionally gets the green pass. Aggravates the heck out of me, to say the least. But what I would say is it's very important for people to fact check and do their own due diligence. Don't listen to what I say or you say and take it as gospel. I do my best to make sure that it is real, because you put your name out there as often as you and I do, we'd look like idiots real fast and no one would want to listen to us. So we both try real hard to say the right thing. But no matter where you're getting information, do your best to fact check it, do your own due diligence. A little bit extra won't hurt. Stuff like that's very damaging. And just the 2 comments you made, no, the central banks don't do it as tradition. They're doing it now for the first time, maybe ever, where in coordination, they're massively buying it. And in terms of, S&P outperforming, you can go back to August of 71 and look forward. You can go back to the beginning of 2020, 2000 and look forward. You go back to the last 5 years and look forward. The S&P 500 has not outperform gold. In fact, it's quite the opposite. So I don't know what else was said in that stupid video, but it's aggravating that the platform doesn't shut it down the way they tried to shut down all of us.
The physical silver market isn't just tight, it's breaking apart at the seams. The world's largest silver refinery in India has run completely out of supply, forcing a sudden and total halt to refining operations. That's not a slowdown, that's a full-blown depletion. In parallel, the London Bullion Market Association, the very heart of global silver trade, is experiencing a continuous bleed from its registered inventories. The shelves are emptying while demand continues to surge, and the consequences are already starting to unfold. For 18 straight days, the silver market has been locked in backwardation, where the spot price is now consistently higher than the futures price. That might sound like a technical footnote, but it's anything but. Backwardation is one of the loudest alarms this market can ring. It signals a full-blown physical shortage, where buyers are so desperate for immediate silver they'll pay more for it today than they would months down the line. In simple terms, no one wants to wait for silver anymore. And that changes everything. It destabilizes futures markets, triggers delivery risks on paper contracts, and pushes industrial and financial buyers into panic mode. This is not a normal cycle. This is a market screaming that the supply chain has fractured. And once those cracks widen, price isn't just going to drift higher. It's going to be violently pulled upward. But backwardation is only the first domino. Because what's happening behind the scenes, where the cost to borrow silver is exploding, is the real signal that the system is entering uncharted territory.
And I remember having this big booklet that came inside of a record album, War of the Worlds, H.G. Wells, and being terrified of it, listening to it over and over again and thinking it was so cool. And my dad said, you know, when that happened, people were like literally jumping out of buildings. They had thought the world was being taken over. Now, that was one thing when information back in the 30s wasn't as readily available as it is now. But I think the more things change, the more they stay the same. You know, I'm in a fantasy football league, and we've been friends since high school. These guys have been doing it for 40 years almost, and 35 years. And a friend of mine in the league took a picture of two of the guys in the league and made them look like they were making out together. It was the realest, most frightening thing you've ever seen. They were at a bar together, having a drink and waving, and the next thing you know, you push play and they stand up and they start kissing, which wasn't true. It was all AI. It said AI at the top. It's terrifying how real it looked. My podcast one of the podcasts I did with Kevin Hauser while in, not yours, but the one I did with Mark Z, while I was in Aruba. Someone like I've done 5,000 or 6,000 podcasts since 2019, as have you, but there's 30 or 40,000 of them out there, as are of yours. So people will take our snippets from our podcast, they'll put their own words and images in and music, and then they'll do it to monetize their channel, clickbait, right? Well, and it really this one made me mad. And normally they don't. Like, I don't know who these people are. Normally they're flattering. They're using my stuff to have people come and watch their shows. But this one said something like, oh, you know, silver's dire prediction, what happened? And I didn't even come anywhere near saying what the silver price was going to do. It was on Friday after the price collapsed a little bit, making it seem like Andy Schectman says it's all going to collapse, it's all over. That aggravated me. But the point of it is that there's deception everywhere. There's deception in AI, which is only getting more sophisticated. There's deception on social media, which again is in many cases I'm okay with because it's getting the message out in a flattering way. They never asked my permission, but that one made me mad. I don't know who these people are. When we talk about, you know, the Warren Buffett thing, I mean, you can easily blow it away. Since we've left the gold standard, gold has outperformed every traditional asset.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
The 39% lease rate on silver is not just an anomaly, it's a siren. This is the cost institutional players are now being forced to pay just to borrow silver in the London market, and it represents one of the highest stress signals in precious metals history. Normally, lease rates hover below 1%, sometimes even near zero. But when they spike like this, it means one thing: desperation. There is no available silver to lend, and the few scraps that remain are being fought over at an extreme premium. This isn't theory. This is hard data telling us that the physical silver pool is running dry and the scramble for ounces has officially begun. When lease rates hit these levels, it triggers a chain reaction. Market makers can't short silver without paying through the nose. Traders begin hoarding instead of lending, and the paper suppression mechanisms, those used to keep silver's price artificially low, start to unwind. But what's even more explosive is the positioning behind this panic. As institutions race to secure metal, retail investors are waking up too. Dealers are reporting delays, premiums are climbing, and even junk silver is disappearing from shelves. The market has shifted from passive buying to survival mode accumulation. And at the heart of it all is this single blaring number: 39%. It's not just a cost. It's a signal that silver's true price has been hiding in plain sight and that the dam is starting to crack.
Both live in Florida, where we've had a satellite office for 17 years. I have brokers all around the country that represent us, like yourself. They're all beholden to the Department of Commerce in the state of Minnesota, where our home corporation is located. That means we're licensed, we're bonded, we're background checked, we take all the continuing education. And that's important in an industry that is federally non-regulated. We've done this for 36 years this February. We're approaching 14 billion in sales. We've never had a material customer complaint. We're not going to ever mislead the public, ever. And I think that does stand for something. That is worth something in an industry where everything you buy is homogenous. Like a McDonald's hamburger in Minneapolis should taste the same in Boca. That's homogenous. Well, the same thing is true. You buy an ounce as an ounce as an ounce. The difference is who you're working with, the reputation, and I guess price is important. But in the end, and we're as competitive as anyone, you know that. But in the end, what really matters is integrity and honesty and track record. And in our case, licensing and bonding, which sets us apart from the competition, in my opinion.
Now we turn the page to something that is entirely...
But it doesn't stop at lease rates. The cost to borrow shares of SLV, the world's largest silver ETF, has surged to a staggering 19% annualized. This is a crucial signal because SLV is often used by institutional short sellers to bet against the price of silver. When that bet becomes so expensive that it starts eating away at their margins, those positions become unviable. And in a market already running out of physical supply, every forced exit by a short seller becomes fuel for an even bigger price rally. What we're witnessing now is the decoupling of the paper and physical markets. For years, silver has been trapped under the weight of manipulated futures contracts and synthetic supply. But the disconnect is finally reaching its breaking point. As physical silver vanishes and premiums explode, paper contracts are beginning to lose their credibility. Traders don't just want exposure to silver anymore, they want the metal itself. Real, deliverable, uncounterfeitable silver. And that shift in preference is causing a cascade of instability throughout the system. Think about it. If the market believed silver would be cheaper in the future, there'd be no backwardation. If shorting SLV was easy, there'd be no 19% fee. And if the supply was plentiful, there'd be no 39% lease rate. But all three are happening at the same time. That's not coincidence. That's crisis. And it's setting the stage for something the COMEX isn't prepared to handle. Because when the paper holders start demanding delivery and the vaults come up short, the entire illusion collapses.
Dollar that they manufacture themselves, which is just a round, but they think that they're buying a U.S. minted coin, or the Morgan silver dollar round, and they think they're buying a U.S. coin. Now, every dealer, ourselves included, sell Buffalo rounds. That's just, everyone sells them. They're the most, they're everywhere. All of the refiners make them. But I would bet a lot of people, I'm always fast to say, remember, these are not American mint coins. because they make the gold buffalo and the gold eagle, but not the silver buffalo. Well, I bet you a lot of people think they're buying U.S. mint product. The point of it is that, you know, it's one thing to buy a round brand new and be misled. And to pay spot over spot. It's another thing to think for a moment that you would be able to get anything below spot at that level, which would just be insanity.
This is, so we're covering a number of different things here. That's things.
And at the very center of this unraveling lies a ticking time bomb. Over $1 billion in net short positions held by managed money traders on the COMEX. These are the hedge funds, the momentum chasers, the so-called dumb money of the futures market. And right now, they're standing directly in front of a freight train. With backwardation tightening, borrowing costs surging, and physical supply collapsing, silver is coiled tighter than it's been in decades. If prices move even slightly higher, these short positions will become unsustainable. The funds will be forced to buy back their contracts, desperately and all at once, triggering a violent short squeeze that could rip through the market like wildfire. This isn't speculation. This is a setup we've seen before. In 2020, a similar squeeze in the silver market pushed prices toward $30 in a matter of days. But that was just a tremor. What's building now is a full-scale detonation. The short interest isn't just large, it's reckless. The positioning is completely out of sync with physical fundamentals, and the traders on the other side, the commercial banks, are licking their lips. Because unlike the past, this time, the smart money isn't short. It's long. And that changes everything. The same institutions that have historically capped silver's upside are now betting on the rise. They've flipped the script, and if the funds don't exit soon, they won't just take losses, they'll be crushed.
That's our curse. We're early and we see things based upon mathematics, logic, and economics. That's Mother Nature, in essence. That's the law of mathematics, the law of economics. Some of these things are not really law, but math you can't run from. And these things always manifest themselves somehow, some way, usually way later than we ever think. But these are the things that we have been saying for a long time, and guys like Alistair who have been saying, and the Western elite have had a very, very magnificent ability to keep the ball up in the air through all sorts of gimmicks and tricks, accounting tricks, injections of money, lying about the measurements of inflation and employment, and on and on and on, right? But at some point, Mother Nature says, well, you know what, your time is up. And at one of these moments when we least expect it, you will see a problem with a major bank. The systemic nature of it. We could look at the problems at the LBMA as an example. All we keep doing is focusing on the LBMA and what happens if there is a silver failure to deliver by one of these massive banks. These are all commercial banks. Well, if a bank fails in silver, fails to deliver, the systemic reaction, the contagion would spiral through everything because they're not just bullion banks. They're banks that have their fingers in all of the other financial pies. The same thing is true here, and that you see one of these banks and you start to see problems with commercial loans. Not only that, you have what's called credit default swaps, where in essence, you're buying insurance against this stuff. And this is why AIG had to get bailed out. If it gets bad enough and you start to see big banks fail because of, you know, bankruptcies, which are non-recourse in commercial real estate, and you just see this cascading effect. Now, we haven't seen it yet, but logic would dictate that we might, right? Who's going back to the office? And it's the opposite of that. Who knows where this leads? And this is when you see people start to pull out of regional banks, and the regional banks are the ones in big trouble, in my opinion, because of this exposure. So, yeah, I think that this is why you see assets like gold and silver and cryptocurrencies like Bitcoin being purchased, because people are trying to get away from the potential for a systemic contagion that's out there. And this is a good example of how it could happen. And if the Fed wasn't concerned about it, well, they'd be a little bit more open about it. The fact that they're so hush-hush reminds me of the FDIC saying, well, if the public really knew, they'd freak out. Remember, we showed that video a year or two ago. It's the same thing, and it's just more of the same thing. That's why people like you, I always say it, are more of a real source of information and news than the media, which is more about divisiveness and entertainment, if you want to call it that. it's not about understanding what's really happening. And John, Rubino, and Alistair, they're spot on. This is a problem that has not yet resolved itself, not even close.
There's one more topic I wanted to bring up about this concern expressed.
So why are the bullion banks, those same institutions notorious for suppressing silver, now positioned for a breakout? Because they see what's coming, and for once, they're not fighting it. The commercial traders, the so-called smart money, are quietly going net long on silver futures. That means they're no longer trying to cap the price. They're preparing to profit from its rise. This kind of positioning flip is rare, and it's powerful. When the banks that usually win by keeping silver suppressed suddenly switch sides, it tells us the system itself is shifting. These aren't random bets. These are calculated moves by institutions with access to information months before it hits the mainstream. They see the backwardation. They know about the empty refineries. They understand the collapse in vault inventories and the rising demand for physical delivery. And they've done the math. The risks of holding silver down are now greater than the rewards. If they stay short, they get squeezed. If they go long, they ride the wave. So they've chosen. And what they're choosing to do, what they never do unless something massive is on the horizon, is to bet with the momentum, not against it. This reversal is like a loaded spring, because when the suppressors become the accelerants, there's nothing left to hold silver back. The resistance disappears, the shorts panic, and the market reprices in an instant. It's not about slow accumulation anymore. It's about front-running a breakout that the insiders now believe is inevitable. And that belief is spreading fast.
Is beginning to fracture underneath the seams. And this is what we said would happen. And that's the part, that's why I'm so fond of the little by little, the logarithmic decay, because the little by little, these things that have been breaking little by little under the seams, instant gratification, even in information and in thought process, isn't quick enough for most people in this country. They aren't able to understand that these things take time. At this level, it is an ocean liner trying to turn. These are very big deals, and they're not getting fixed organically. And the problems with commercial real estate are only going to get worse, as are the problems with residential real estate. The only way the residential real estate problem gets better are for prices to go down and or for interest rates to go higher, not lower. That's what got us in this problem to begin with. Well, the commercial real estate is a whole nother animal altogether. You got all of these companies that realize, well, we're just as productive working away from the office as we are in the office. So why spend all the money? And it's creating a real problem. The banks are not out of the weeds yet. And when you see the Fed coming in and quietly doing this without, again, our media just is pathetic. Our media, guys like John Rubino, God bless them, guys like you, all the people who are telling the truth and getting the real information out, these are the ones that were shadow banned during the previous administration for misinformation that turned out to be true. But here again, where is the journalistic integrity? Where are the news media outlets talking about what is exactly happening? And what it means is the banks are in trouble. And not only that, no one wants to leave their money in the bank. They'd rather move it to treasuries, which short-term treasuries with disintermediating the bank, or even into money markets away from the regional banks and into the bigger banks. The problems are not done yet. And this is a good sign of it. When they are trading their mortgage-backed securities instead of their treasuries, they're in need for cash, and cash quick, and they're in trouble. It's kind of like, you're pawning off your wedding ring at this point, and hopefully you'll lend it to the pawn shop. Hopefully you'll buy it back. Because
that belief isn't just spreading, it's institutionalizing. The world's biggest financial players aren't just making forecasts anymore. They're changing their entire strategies. Bank of America has raised its silver price target to $65 an ounce for 2026 and expects an average of $56.25 until then. But that's not the headline. The real story is how these institutions are reallocating capital. Morgan Stanley's CIO is telling investors to abandon the traditional 60-40 stock and bond portfolio in favor of a split that includes 20% gold. Jefferies is calling for gold to reach $6,600, and Bank of America's Michael Hartnett is even floating the idea of a 25% gold allocation as part of a balanced portfolio. And here's the key. When gold becomes a recommended hedge at that scale, silver follows. This isn't about fringe analysts anymore. This is the mainstream financial world waking up to a systemic threat and positioning for it aggressively. Jeffrey Gundlach, one of the most influential bond investors alive, says a 25% gold allocation is not overweight, really. That's a staggering statement. It signals a complete rethinking of risk, of safety, of value. And while these firms publicly tout gold, they're quietly pouring into silver. Because silver is the leveraged play. It's the undervalued twin. When institutions go heavy into gold, it's silver that explodes. This is a tectonic shift in capital allocation. For decades, metals were an afterthought, something you sprinkled into a portfolio. But now, they're being treated as a core position. Not for growth, not for speculation, but for survival. And that shift means silver's coming move won't just be fueled by retail panic. It'll be driven by deep institutional demand, the kind that doesn't sell into strength, the kind that buys and holds until the system resets.
And they were showing videos from 2017. I digress. We don't need to talk about that. But what I will say is that we've settled for a long time, Dunnigan, that the banking issue is not over. And it's been muted, yes, for sure. But what this is, in essence, is a bunch of commercial real estate and residential real estate loans are going bad. Auto loans, they're all going bad. People aren't paying. They're running late. They're delinquent. No one's in office buildings. I was at my attorney's office in Minneapolis last week. They have 3 floors of an office building. Felt like I was in a morgue, literally. And they re-upped it like right at the beginning, right before the pandemic hit. They re-upped a 10-year lease. I mean, in downtown Minneapolis, you could have 10,000 people on these 3 floors, literally, and there's no one there. It's crazy. But this is the kind of problem, not my attorney's office, but many like it, where they're delinquent. They're not paying. They're going into forfeiture. And so you have a bunch of these loans that are going bad, which makes the banks run low on cash. They're not getting their payments. So to stay afloat, they go and they hit the repo market, where this is where banks trade assets, typically U.S. Treasuries, for quick overnight loans from the Fed. I'll give you my treasuries. You give me some money, and then I'll buy back the treasury the next day or next week or whatever. It's overnight. It's next day. Some are longer than overnight, but that's why it's called repo. It means repurchase. Here's my treasury. Give me some money so I can pay my debt. I'll give you back the treasury, or I'll buy back the treasury the next day. Great. The scary part about all of this is that now these banks are pawning off their risky mortgage-backed securities instead of the safe treasuries. That is the sign of stress. That is what should be disconcerting. This is why the Fed injected almost $9 billion and opened up a $490+ billion emergency facility. Shh, don't tell anyone. No one knows about it. It's a $500 billion. And you don't do that unless something.
And behind all of this, the backwardation, the short positioning, the institutional pivot is a silent engine driving it all. A $500 billion bailout that almost no one knows about. The Federal Reserve has quietly opened a covert repo facility, injecting nearly $500 billion into the financial system. But this isn't your typical liquidity program. It's not about short-term volatility or seasonal cash needs. This is about keeping the banking system from collapsing under its own weight. Specifically, regional banks, those with massive exposure to failing commercial loans and toxic mortgage-backed securities, are now pawning off their worst assets just to stay alive. And the Fed is taking them. This is not normal. In a healthy market, banks post treasuries, safe, stable collateral. But that's not what's happening here. These banks are bringing garbage, non-performing debt, worthless real estate-linked securities, and the Fed is quietly handing them cash in return. It's a silent emergency, papered over by financial jargon, but it exposes one undeniable truth. The system is breaking from within. And when banks are this fragile, when they're dumping toxic assets just to keep the lights on, confidence evaporates. Investors flee the system. Capital seeks safety. And that's when silver and gold come alive. Because precious metals don't carry counterparty risk. They can't default. They don't rely on someone else's balance sheet to hold value. And right now, the people closest to the fire, the insiders, the institutions, the banks themselves, are rotating into the one thing they can trust when everything else starts to burn. This isn't just about silver's demand spike. It's about a complete revaluation of what's safe, what's real, and what holds value when the bailout machine is running at full speed and still falling behind.
Down your bond holdings by 20%. Michael Hartnett for Bank of America, this is the one that just said, 60, whatever, $65 on silver. Michael Hartnett's newsletter, I don't know how much it is, but I bet it's 10 grand a year. He just came out and said, no, it's 25, 25, 25, 25. 25% stock, 25% bond, 25% short-term treasury, and 25% gold. Whoa. Then you get Jeffries. Now, as you mentioned at the onset of this meeting, we were blessed by Prudential Beige about 20 years ago, and they nominated us. The authorized resellers, the 6 or 7 of them, can nominate one primary reseller, or the primary distributors can authorize one authorized reseller. And they did. Prudential Beige authorized us or nominated us to be an authorized reseller, one of 27, about 2 decades ago. God bless them for that. Walter Pahowicz, if he's still out there, Walter, I love you. He used to run their desk. They got bought by Jeffries. And Jeffries Beige was the name. Jeffries Beige was a primary distributor for all the major mints. They understand gold. They subsequently got out of the market, sold off the Beige name, and it's just Jeffries. Their head trader is saying $6,600 gold is their next stop. They understand gold. But maybe the biggest of them all is Jeffrey Gundlach, the bond king, the man who's made his mark, his fortune, and his moniker of being the bond king by selling bonds, who just came out and said a 25% portfolio allocation to gold is not overweight. Really? So when you see these people at these levels, and then put into it all the stuff coming into COMEX and the draining on the LBMA and the high lease rates and all of this stuff, the Judy Sheltons of the world, and the Trump saying he who has the gold makes the rules, and Besant saying, I want to remonetize, be part of a new monetary. Keep going. I'll keep going. And I'm telling you, and I hate to say it, I cringe saying it, but this time it's different. And look at gold. Got the snot kicked out of it by over $100 last week on Friday. And what are we at today? We're up $108 right now as we speak. The physical demand is different than I have ever seen, as are all of these things. People at that level, speaking to institutional traders at that level, saying 25% allocation is good. Never seen that before, man. Not even close. That's all.
And the storm is already making landfall. At the root of this quiet financial collapse lies the commercial real estate market, a sector now crumbling under the weight of its own delusion. Office buildings in major U.S. cities are sitting empty, vacancy rates are at multi-decade highs, and hundreds of billions in commercial loans are coming due with no buyers and no refinancing options. This isn't just a slowdown, it's a systemic time bomb. Regional banks, which make up the bulk of CRE lending, are drowning in bad debt with no way out. And as defaults pile up, those banks are forced to lean even harder on the Federal Reserve's covert liquidity programs, further exposing the fragility of the entire system. But here's what makes it even more dangerous. This collapse isn't loud. It's silent, decaying day by day, building pressure beneath the surface. Most investors won't even notice until it's too late. And that's exactly what makes it so deadly. Because when the dominoes start falling, when just one mid-sized bank fails unexpectedly due to CRE exposure, it sets off a panic. Not just in stocks or bonds, but in trust. And when trust vanishes, silver explodes. You see, silver isn't just a hedge against inflation anymore. It's becoming a hedge against systemic collapse. The smart money knows this. The institutions know this. Even the central banks know this. That's why physical supply is vanishing. That's why lease rates are breaking records. That's why backwardation won't go away. Because the financial architecture is cracking, and silver is one of the few assets not built on those crumbling foundations.
I think are worth mentioning. The largest silver refinery in India evidently has run out of stock for the first time in history. India being one of the largest buyers of physical silver. That's a big deal. I think worth certainly mentioning. The managed money is short by over $1 billion on silver, meaning the commercial banks took the other side. I wonder how that's going to play out I would suspect you'll see silver really start to move this week when the managed money, the dumb money, in relation to the commercial banks, the ones that seem to always be on the right side of the trade until one day they're not. And maybe this is the one day one would expect silver to really start to move higher here right now. I don't like to make those kind of predictions, but I will tell you that this is very unusual to see how short the managed money is. At the same time, you have, right now that the LBMA is blowing up in terms of running out of stock, you have, for the 18th day in a row, backwardation between spot and futures. Right now, it's about $1.24. This tells you that the people are paying extra to get real silver now, not in the future. This is not bearish. This is a panic for the real metal. At the same time, short sellers are now paying a 19% annualized rate just to borrow SLV shares, where we see a lot of shorting, and a 39% lease rate on the LBMA. This is not indicative of a well-functioning market. Bank of America on Monday raised its forecast of silver to 65 per ounce by next year, with an average of 56 and a quarter. Until then, they also lifted their outlook to gold for 5,000. And the last thing that I will say is, and I may have repeated this last week, but for people who haven't heard this, you got 4 or 5 things that are incredibly bullish. You got, as we mentioned before, Morgan Stanley saying no more 60-40, 60-20-20. Get rid of half your bonds, buy gold with the other half. 60% stock, 20 bond, 20 gold. When have you ever heard a financial advisor say 20% in gold? This is from their chief investment officer, their CIO. This guy and the people that I'm about to mention speak to not the plebes, but to the institutional level traders, not to the rest of us. They're saying put 20% of your money in gold and pair.
And the rot goes deeper. That repo facility, the silent bailout pumping liquidity into the system, isn't being backed by treasuries anymore. It's being backed by mortgage-backed securities, the same toxic instruments that helped trigger the 2008 crisis. Except this time, there's no warning bell, no headlines, just quiet, backroom transactions where the collateral is collapsing in value while the Fed pretends everything's fine. The banks showing up for this facility aren't healthy. They're desperate. They're drowning in non-performing loans, especially from the commercial real estate sector. And rather than admitting the losses, they're swapping junk paper for fresh liquidity just to keep up appearances. This is why gold is rallying. This is why institutions are allocating 20%, 25% of their portfolios to metals. Because those at the top know what's coming. They see the same playbook unfolding. Over-leveraged banks, bad debt disguised as assets, and a central bank trying to mop up the mess without triggering panic. But the silver market? That's where the rubber meets the road. Gold can absorb the fear, but silver reflects the cracks. Every mortgage-backed security being pawned off is another data point that this system isn't just strained, it's collapsing in slow motion. And when these cracks spread, and they will, it won't just be the banks that panic. It'll be the public, because trust evaporates quickly once the illusion breaks. And in that moment, silver won't be some overlooked commodity. It'll become the lifeboat for anyone trying to escape the storm.